Okay, now we're going to talk about non-conventional loans, and the first one we're talking about is an FHA or Federal Housing Administration loan. The FHA is a government agency, works with HUD and was within HUD, and it actually functions as an insurance company. So it insures a part of the mortgage loans made by approved lenders to buyers. Lenders set the interest rates between themselves and the buyers, and also may charge points on the loan. And the most common loan we can find normally is a 203B FHA loan, which is a fixed rate mortgage loan for about 30 years. The characteristics: they are made by FHA approved lenders, and the lenders may charge discount points. There is usually a minimum cash investment or down payment of 3.5%. Therefore, the loan can be up to 96.5% loan to value. The FHA does set limits on the amount that can be borrowed, depending on the average cost of housing in various regions of the country. So you do have a small down payment, and this is only for 1 to 4 family homes. And looking at Manatee County, we can see the loan limits here: $299,000 for a single family home, and then up to $575,000 for a fourplex. You won't be asked a question on that, by the way. Characteristics of an FHA mortgage loan. Well, first of all, you do have to pay an insurance premium. The first one is the upfront mortgage insurance premium, which is usually 1.5 to 1.75% on the loan value, and that's paid upfront when you take out the loan at closing. Then you also have the mortgage insurance premium, which is an annual premium, but they divide it by 12 and you have to pay it in monthly installments, and that is added to the monthly payment. And we have to remember that this will be added to your monthly housing expenses when you come to calculate your qualifying ratios. We've already discussed TOR. Remember that the total obligations ratio was 36% for a conventional loan. Well, for a FHA loan it is 43%. So they do allow you to spend more of your income on your obligations. And of course that will include your housing expenses. But we also want you to qualify for a new ratio, which is called the housing expense ratio of 31%. Housing expense ratio is basically how much of your monthly gross income are you going to be spending on your principal and interest and tax and insurance and your monthly insurance premium. And when you work that out, it mustn't exceed 31%. Once again, we just talk about the total obligations ratio, which is my total monthly obligations divided by my gross income mustn't exceed 43%. Here's an example we have of a person who has a PITI of $900 a month, plus an insurance premium of $150, plus a car payment of $200, plus a student loan of $150, and a gross income of $3,500. To work out the housing expense ratio, all we have to do is take into account the housing costs, which is the $900 for the PITI plus $150 for the mortgage insurance premium or the monthly insurance premium, and you come up with a monthly housing expense of $1,050. Divide that by the gross monthly income and you come to 30%. To work out the total obligations ratio, we also add to that the long-term obligations, which in this case would be an extra $200 for the car payment and $150 for the student loan. That comes to a total of $1,400 total obligations. Divide that out and you get a TOR of 40%. So both are actually okay for the loan. Remember that the HER was 31% and the TOR cannot exceed 43%. So they are under in both cases. So the characteristics of an FHA mortgage loan, the first one is it's fully assumable. In other words, it doesn't have a due on sale clause in the mortgage, and the loan can be assumed by a qualified borrower. But this is only for owner-occupied homes only. Once again, as with all loans, the interest rate is negotiable between the lender and the borrower, not set by the FHA. But they will require an appraisal by an FHA approved appraiser, and they will be checking for minimum property condition. So it has to meet certain standards. If you are building a new development and you want to make sure that your property will qualify for FHA mortgage loans, then you do need to actually run it by FHA to get a commitment that they will insure for your development. So, and the way you do this is, as a builder, you actually make sure you build to minimum construction standards. And that's all we're going to do on FHA loans. I'm going to stop right there. That was a short one, and the next video is going to be on VA loans.